This is going to be our tool, which we are going to use throughout this BF1. In fact, it will be useful going forward as well. Again, I'm going to explain this shortly, and then we would start doing the examples. Because this is more like a practice session, there's actually nothing more left from the book to be taught. Uh, so the basic elements under which the entire accounts and finance sets down is these five elements: asset, liability, revenue, expense, and equity. And this is out of these, uh, we prepare, there are four types of financial statements. One is income statement, as we've discussed. Then there is the balance sheet. But before preparing balance sheet, we prepare a statement of changes in equity. And the last one is cash flow. So we prepare these four statements, and these are the financial statements that we ever have to prepare. That's all we need. Out of these, the two most important one is the income statement and the balance sheet. So there are these five elements in accounts, and entire accounts rest upon these five elements. So out of these, revenue and expense are part of income statement. I'm going to write down the shorts for them. Statement of changes in equity is called SOKI for short. Why is it coloring? Balance sheet is, well, it is what it is. And cash flow statement is going to be CF. These are going to be my shortcuts, short names, acronyms, and we're going to use those. Revenue and expense fall in income statement. Income statement is made entirely of uh, revenue and expenses. And then our balance sheet is made up of asset, liabilities, and equity. And statement of changes of equity is, of course, going to be made up of um, equity. So remember these five elements, and now we're going to discuss again for the iteration before we start our today's practice session, that how they operate. When asset increases, we have to label them. Of course, in accounts, they have a name for those operations. When asset increases, it will be called debit. But when asset would decrease, we will say we're going to credit it. When liabilities and revenue they decrease, we call it debit. Whereas when they increase, this plus sign shows increase, negative would represent decrease. So when liability, revenue, and equity they increase, we call it they are being credit. Liability is being credited, which means it is increasing. So if I were to say asset is debit, which means asset is increasing. But we are going to use these operators, and we are going to use the plus minus signs as well. The rule of accounting is that debit comes first, credit comes afterwards. So your left column should always be debit, your right column should always be credit. Now, if we were to look at some entries, for example, I want to start with income statement only. So I would say I made, uh, so the way a journal entry is passed. Okay, even before that, let me tell you that the process through which these statements are prepared, the first one is journal entry. The second step is called ledger. From ledger, we create trial balance. From trial balance, we create income statement. And all these statements are created. These are the financial statements. Mm, insert. these are the income, these are the financial, collectively they're called financial statements. And these are the processes through which we have to go through to create the financial statements. Okay. So the basic building block is always debit and credit, and we do it with journal entry. We journalize it. The purpose of journal entry is just like, a reporter who's a journalist, as we call them, they journalize the events in front of them. Accountants are also like reporters. We're journalizing the story of a business. So let's assume couple of entries, couple of transactions that are taking place. Uh, for example, we start a business and the business is, let's say it's uh, Organico is the name of the business, and we sell, say, um, some fast food items. That's our business. Okay, this is just for example purposes. So one entry could be we made a sale of 100 items, 100 food item of 100 food items at the rate of 10 each. Let's keep it simple. So you're going to get simpler transactions like this. Then to make that sale, we would say that we bought those food items from somewhere at wholesale price. We bought those items at 7 each. So, uh, and we are going to assume, and we made the sale 10 each in cash, and we paid for them in cash. And we bought these items in cash. So the first thing we need to understand is what is going on over here. There are two things, and as I discussed before, each transaction would comprise of two legs, or which means two things would be happening. It could be more than two, but at least there would be two things that we have to at least identify. Excuse me. So 100 food items are being sold. So one thing that I can see is that a sale is taking place, so I would write down sales. The other thing I notice is that we are selling it in cash. So we have to write cash as well. And in the other entry, we what we can see is we bought those items at 7 each in cash. So we're purchasing something, or we can simply call purchasing purchases. What we buy from the shops or store, we call them groceries or our purchases, right? So we can call it that. And we can see that cash is also getting involved in the transaction. So now the first thing, first step was, this is our first step in journal entries. We have to identify the items or the elements or whatever you want to call them, what is happening. We have to identify the transactions, or we have to identify what is going on, the things which are coming into play. And they have to be at least two, because that's what a transaction is. Something is coming, something is going, some movement, right? So we have to identify. Step number two, mm, step number two, I want to identify them according to this chart, that what are the operators? What elements, let's call them elements. These are the elements of accounts. That what is going on over here. First of all, sorry, we have to identify them according to these charts. What is this that we are talking about? So what could cash really be? When we say, okay, cash is with a business, it is uh, when we try to value it a cash, or when we try to value an individual, we would say, what are their assets? And they would say, hey, I have a car, I have a house, I have couple of I have tools in the shed, I have cash. So those are the assets. And also your assets are something that you have in the bank as well. So your bank balance, your cash, your jewelry, your car, the amount of car that you have paid off. If the car is on lease and you've paid say 50% of it, then the amount that you have paid off, that is your asset. The remaining is still, you have to still pay, you owe that money, right? So we identify that cash is actually an asset. Then what is sales? Can anyone, Michelle, can you tell me what sales would be? Can you like just make a guess according to these five elements? What could be sales?
Revenue.
Make a revenue, correct. So anything that is related to sales, whether you sell in cash, whether you sell in credit, doesn't matter. That is your revenue. Now, you could not have made this sale unless and until you have purchased those items. If you don't have it, then you cannot sell it. So that is your purchases. You bought those items. So, what would be purchases? What element would the purchases fall under? They would fall under expenses.
Expense.
Yes, correct. And cash we know is an asset. So now we need to see what is actually, we identified the element, we identified the items, then we identified the elements that what they fall under in the accounting. Now I want to know in the third step what is happening, whether they are increasing or they are decreasing. So in the first uh, in the first example, cash is coming and sales is also increasing. Two things are increasing. Cash is also increasing, and since we're making the sale, so we're increasing the sale, right? So both the things are plus. And in the second example, we're purchasing something, our which is our expense. So is purchase, are our purchases increasing or decreasing? What do you say, Michelle?
Decreasing.
Increasing.
Oh,
Exactly. And what is happening to the cash when we are purchasing?
decrease. Oh, sorry.
Decrease.
Oh, that's
No,
okay.
correct? Oh, sorry, but yeah, because cash is going out, cash is coming in. When cash is coming in, it's increasing. So sales also increasing because we are selling the item, so our revenue is actually increasing. So now we would just simply look at our table and we will see what's happening. So when asset increases, we debit it. And we have to figure out the amount, and which would be 10 multiplied by 100. And the other leg of the transaction would be exactly the same. The amounts of debit and credit should always come the same. It should always balance. So sales is also increasing. Now I'm simply going to go over my chart and I'm going to see sales is revenue. What happens when revenue increases? We credit it. So I'm going to put in underneath credit the same amount, sorry, same amount that we put in the cash sales, in the cash when the cash was increasing. Now I have to identify expenses. Expense is increasing. What happens when expense increases? We do debit, but we have to take the amount which is given in this example. So it's saying 7 items at the rate of 7 each, these 100 items were purchased. So that's coming 700. The second is cash is decreasing. Cash is an asset is decreasing. What happens when an asset decreases? We credit it. And there it is. So we just passed two journal entries. So this section has been taken care of. General entry level is taken care of. So based on this, let's go and do an example from our, this is chapter 1 homework. Jack Tasker opened his auto repair shop in November 2023. The balance sheet at November 30, 2023, prepared by an inexperienced part-time bookkeeper, is shown below. So assets come, we discussed it in our very initial lectures. Let me go back over here, trial balance. Something's wrong today. When we were doing this example, we were looking at how revenue and how balance sheet is created. In balance sheet, all the assets come on the debit side. Sorry, on the left side. And if I were to do Alt H merge center, or wait, and equity plus liability come on the right side. And you can see that I've written equity, liability, asset, they fall under balance sheet. So asset comes on the left side, equity and liability on the right side. So that's a lot of information and I can understand that. Jack Tasker opened his auto repair shop in November 2023. The balance sheet at November 2023, prepared by an inexperienced part-time bookkeeper, is shown below. Excuse me. So we have the assets, cash on the debit, on the underneath the assets, not debit credit. It's just asset side. Accounts payable, equipment, capital, total income, total equities. So this is entirely wrong, and we have to correct it. So cash is right. Cash is an asset. So the way this goes is we just simply, excuse me, we just have to simply identify each of these items as the element of accounts and then put them in the right place. That's all we have to do. So I'm going to take a snapshot. How do I do that? Uh, okay. This is all I need. Okay. Let's see if I can bring it here. Too big. But I can manage. I only need to see this chart. And now I'm going to solve this for you. I'm going to do it. I'm going to call it the asset side. Order must center the liability and equity. Sorry, order border all, order border all assets, liabilities, and equity. So cash is an asset. That is correct, like we discussed. I would put cash on this side. All we have to do is just identify the items. Accounts payable is the next one. So what's happening in accounts payable? Payable means the name suggests it's like something you have to pay to someone. It's not your money. It's not even money. It's something that you owe to someone. For example, I decided to these items that we bought on cash, if I were to change it and I would say on credit, which means buying something on credit, like using your credit card, you pay for it now, but actually you haven't paid out of your cash. It's a liability. It's something that you owe. Anything that you owe would always be as a liability. And these are the things that we hear in the news and around us all the time. So it's kind of self-explanatory. So we're going to take the same example, and I made those purchases. So purchases would be the same. That element would be the same, but I purchased it on credit. So what we say on credit means that it's like accounts payable. So when purchases increase, it's an expense. Uh, But when accounts payable increase, so first of all, we have to identify what is accounts payable, and we just discussed it's a liability. And what happens when liability increases? We credit it. But liability, the operator, the sign for that is going to be plus. So we did the same transaction, but this time the amounts remain the same, but the heading changed. One thing is accounts payable, and this falls under liability. So this is the process that we have to identify each of the elements. Accounts payable is a liability. I will put it on this side because it's coming under and the spellings are wrong. Okay, sorry, accounts payables. So that is all we have to do. We just have to change their position. The next one over here is equipment. So when there is an equipment and we don't know how they bought it, we just know they have it. So we're going to assume that they own this equipment is in their ownership. And it's just like, think of equipment like a car. And what was car? Car is an asset. So any equipment that a business owns, which they use to generate profit or do their business operation, is an asset. So this is how, step number 2 that we were doing over here. Step number 1 was identifying the items that are coming into play in our transactions. And then second step was to identify the element. So this is the second element. This is the second step. We're just simply going to identify what they are. So this is your homework. Equipment that is done. And the third thing is Jack Tasker Capital. So capital is the other name for equity. Capital is the amount of money that a person brought in the business to start the business, and they bought all this equipment and cash. That is their capital. So capital will come on the equity side, and what we do is first we leave the top room for liabilities, and towards the bottom we put the capital. That's the way it's done. It's just a rule. Jack Tasker Capital. So we've done cash, we've done accounts payable, we have done equipment, we have allocated Jack Tasker capital. The last one is total income, and total income is not the correct name for it. So this one is entirely wrong. I would cross it out. The next thing on the right side under liabilities and equity is parts and supplies. So parts and supplies cannot be coming on this side because parts and supplies, think of parts and supplies like in our example, we have Organico, and in Organico business, for example, we decide to produce something. We decided to make tacos. So what are the elements that we need to produce tacos? We need some vegetable, we need those taco crust. So we buy that from the store and we keep them with us. And when the order would come, we would quickly prepare taco and sell it. So those single taco, the items that we need, the ingredients we need to prepare the taco is our inventory. Inventory is anything that we keep with us in the storage and we use it to process or produce our final goods or services. So over here, it's a repair shop. So obviously in a repair shop, they're going to have parts for the automobile. They're going to have certain supplies for what could fall in supplies. Parts, I understand, is going to be like the serpentine belt, the radiator, maybe some nuts and bolts, rivets, things like that. And so that would be parts. What is supplies? The concept of supplies is that supplies is anything that is consumed. It is not an individual identifiable item. It just gets allocated, applied. For example, grease, oil, those are not individual, they're not parts, they're supplies. Anything that gets consumed would always be called supplies. So I'm going to put parts and supplies because these are the assets of the company. If they were to sell the auto repair shop, parts and supplies would be sold. They've already spent money and they're going to keep it with them till they use it or they completely sell it off. So anything that when you sell and you get money from it is either your mainstay business, then it's called revenue. But if it's not, if it's like consumed in the business, then it's an asset. So parts and supplies is not their mainstay business. For example, in our Organico business, tacos was not our inventory, but the items used to produce tacos was our asset. They were our supplies and inventory or parts, whatever you want to call it. But taco was our final product, and that is the one we sold. So I'm going to call parts and supplies our asset. The next thing is accounts receivable. So account receivable are generated when you sell something on credit. In our example over here, we bought we bought these items first on cash, then we bought the same things on credit, and we have yet to pay for it. So since we haven't paid for it, we owe the money to someone, and that's why they call accounts payable. Now let's exactly reverse this transaction, and we say we made sales of 10 food items on credit, which means we have yet to receive cash. So first, excuse me. So the first thing that is happening over here, we have to step number one, identify the items coming into play. The first thing is sales. Sorry, let's bring it down. Sales. But now we're selling it on credit. To whom we are selling, we don't know, probably customers. So I would say I sold this to my customers. The other item is the customers. Now we have to identify customers and if we were to allocate all our customers under one roof, we can say we have to receive money from those customers. What is happening? We have to receive money from those customers. So we can club them and we can say that these are the accounts that are still receivable, which means we have to receive money from them. And to any group of people, individuals from which we have to receive money, the accounting term from that is accounts receivable. So I'm not going to call them customers. I'm going to say these are my accounts receivables. Now uh, so sales we already know is revenue, and revenue is increasing. I'm going to put the plus sign over here. Sales is revenue. Revenue is increasing. I did that. What is accounts receivable? So anything from which you're going to get a future economic benefit in the future. You're going to use it or you're just going to sell it, whatever you're going to do, and you're going to get money from it. It will always be your asset. Asset is something which generates you business, which generates you money. So accounts receivable is something that is going to generate for you money in the future. When these customers are going to come back and they're going to pay you, you're going to generate money. You're going to generate cash. So this is like conversion of one asset into another. But of course they are separately identifiable. It's not cash. It is yet to become cash, but it's still an asset. And one asset, so we identify it as asset. And what happens and what is happening over here? It's increasing, right? They're becoming your asset. Accounts receivable, somebody owes you money, and that is why you call this an asset. So what's happening over here? What happens when um, asset increases? You debit it. Say we did it for 1,000. Sales is revenue. What happens when revenue increases? You credit it 1,000. And you can see one thing that our debit side and our credit side is always equal. And if you look at the balance sheet, asset is something that is always debit. Liability and equity, this section, liability and equity, when they increase, it's always a credit. So they're automatically coming on the opposite side to each other. And if I were to put all my assets on debit side and put all my liability or equity on my credit side, you would see the total of balance sheet would be balanced. That is why it's called balance sheet. So let's continue this further and close this one now. So now we know what an accounts receivable is. It's, oh, come on. So that is also done. Now last item is mortgage payable. And the name is suggesting it's a liability. It's something that you owe to someone else. Mortgage is something that you owe to the bank or to the from wherever you got the mortgage financing, finance house or whatever. It's payable. It's a liability. The name suggests itself because you have to give it to someone. You enjoying the benefit today, but you have yet to pay for it. So that is coming on the right side under liabilities and equity because that is what it is. So let's see if we put the amount 6,300. Equipment is 14,175, 14,175. Parts and sorry, huh? Equipment is 22,0. Oops, 22,050. Accounts receivable 47,250. 47,250. I hope I'm getting it right. Accounts payable 34,650. Mortgage payable 28,350. Jack 26,775. And the amount is still same 89,775, which is coming over there. I'm going to copy and I'm going to paste over here. And this is also doing the sum. It's balanced. That is why it's called the balance sheet, because it always balances. 89,775. So there you go. We did this. Now let's try and see what the solution is and what we did. Oh, come on. This much. So my solution was cash accounts receivable, cash accounts, oh shit, oops. Cash accounts receivable, parts and supplies and equipment, cash accounts receivable, parts and supplies and equipment, accounts payable, mortgage payable, total liabilities was coming. It's just they're just adding these two things up. Actually, you see, you don't even have a drop down over here. These are the drop downs. You just have to do a drop down and select them. So my solution and their solution matches, and we have the total of 89.7. So that is what you have to do. The entire, I think, homework is made up of the step number 2. But you cannot do step number 2 if you are unable to do step number 1, which is identifying what is going on. However, in your examples, what they have done, they've already identified what these items are. You have to identify if it says cash, whether it's an asset or not. If it's sales, what is going on. You will not get sales. I don't know what you would get. Let's see. So basically, you have to just perform step number 2. It would automatically balance. Let's go over a couple of more examples. We have 13 questions. I will not be able to do all 13 for you. Susan Huang began practice of law, and with an initial investment, basically what do we have to do? I always go to the question first, and the main the main task. I just read that, and then keeping that in mind, then I go and read the rubric of the question, what's going on. So our net objective, final objective is prepare the corrected financial statements. And as we discussed, financial statement made up of income statement, balance sheet, no, sorry, statement of changes in equity and balance sheet. So we have to prepare three things, which is pretty heavy now. I will not do balance sheet, but I will do income statement and statement of changes in equity. Susan Huang began the practice of law on 1st October 2023 with an initial investment of 10,500 in cash. She made no withdrawals during the month. After completing the first month of practice, the financial statements were prepared by Ryan Blair, the secretary bookkeeper Miss Huang had hired. Miss Huang almost burst out laughing when she saw them. She had completed a course in legal accounting in law school and knew the statements prepared by Blair left much to be desired. Consequently, she asked you to revise the statement. The Blair version is presented as follows. So this is funny that we are just starting the accounts and she's asking us to prepare the financial statement. I mean, that's just stupid, right? But hey, we're not getting paid to prepare this. We are paying to prepare this. That's just for laughs. Okay. So cash, and we can see the mistakes over here. A supplies expense is supposed to come. Supplies expense. What the hell is supplies expense? Now they're confusing. I told you that supplies is an asset, but they're also attaching the word expense to it. So if it says expense, then I would take it in income statement. Anything that says income goes in income statement as revenue. Anything that says expense goes in income statement as an expense. Accounts payable, anything that says payable is a liability. Rent expense, it's an expense. Supplies, this supplies, standalone supplies is an asset. It's like an inventory. So let's see, this you can now do. All you have to do is cash is correct, furniture is correct, suppliers expense will be removed and taken to financial statement, income statement. Accounts payable would go on the liability and equity side. Rent expense would also go in the income statement. So supplies and rent expense would go in the income statement, and accounts payable would come on the liability side. That's it. Your balance sheet is done. Income statement. Income statement revenues, legal revenue, correct. Account receivable. It's receivable, it's an asset. So it will come on this side, on the asset side. Expenses. Salary expense, correct. Telephone expense, correct. Law library. Somebody was asking me about that as well. So I'm going to assume law library. We look at the scenario and we try to understand what's happening. Susan Huang is practicing law and she has her law firm. So law library expense. Maybe you cannot own a library. Nobody owns a library, and which library comes in $8,400, right? So it probably means this is like she's spending money on going to the library, getting the library card or the books she's getting issued. So it's costing her. I don't know in which country it's like this. Kind of unusual. This is where students get confused when they try to look at the real life and try to analyze. Library in Canada is for free, but maybe it's in some country where the law like when you go to a library, you have to pay for it somehow. So maybe she has to pay for it. So it's an expense because it's on a day-to-day basis. What is the difference between an expense and an asset? For example, supplies, expense, and supplies. I mean, that's just weird, right? Because it says expense, so it's an expense. There has to be a rule. In accounting, it's all about rules. The better you are with the rules, the more you're going to succeed. How do I delete this? Gone. So for that, we introduce to the definition asset, expense. We need to differentiate because we can see that both asset and expense, when they increase, they become debit, and when they decrease, they become credit. So we have to have a definition for it, and I would very much like to go into that. Or, or we can use the one in our book. Yeah. Okay. So they say that the definition of assets describe what an organization has invested in, such as land, building, machinery, and cash. Liabilities describes non-owner financing. Basically, like, okay, these are not good definitions. So wrong. This is good example. You can do these examples as well. Mm, well, what's the? So let's look at the official definition of assets. it would be good if you could memorize that. Definition types example. This is Investopedia. If you have any doubt, you can always go there. This is my go-to resource. An asset is a resource. Remember in my first some of my earlier lectures, I was talking about the concept of source and resource. Assets are the resources with economic value that an individual, corporation, country owns or controls with the expectation, the most important element, expectation that it will provide a future economic benefit. Not just a benefit, future economic benefit. So there you go. This is the main example of main definition of asset, which is universally used. It's a resource from which you derive future benefit. Now let's look at expense. Expense in accounting are the cost of doing business, including the sum of all the activities that will hopefully generate. Let's go to Investopedia. Come on with the enough with the advertisements. An expense is the cost of operations that a company incurs to generate revenue. It is simply defined as the cost one is required to spend on obtaining something. As the popular saying goes, it costs money to make money. And we can best understand it with the examples. Common expenses include payments to no, employee wages, factory leases. Payment to supplier is not really an expense. This is wrong. Employee wages, factory leases, yes. Equipment depreciation, business are allowed to write off tax deductible expenses. These are all expenses. This is good, fairly good. So you can read more about expenses over here. So the difference between asset and expense is that expense is incurred now to generate revenue. An asset is something that you keep with yourself and it will generate you money or profit in the future. And assets are of two main types, short-term, long-term. Anything that is consumed in less under 1 year. Now, where is my Excel? Anything that is consumed under 1 year is called current asset. More than 1 year typically is called non-current asset. Now it has various names. Some would call them fixed assets. Basically, fixed asset means something that cannot be moved. Land and building are fixed assets because they cannot move, but they are non-current because they have a really long life. 50 years, 60 years. Land has like an indefinite life in most cases. Non-current fixed assets, or what are they also called? They're also called long-lived assets. So they have various names, but it essentially means the same thing, that it's anything that has more than 1 year in life. And current asset, something that gets consumed within a year. So supplies and inventory is an example of current asset, but it's still an asset. So I hope that part is clear. An expense is something that you just incur to get something done. Rent is an expense. It's a current item. It's going to happen now. You're going to pay it now. You're going to consume it now. A cell phone bill, that is an expense. You're going to consume it now and you're going to pay for it now. So that is an expense. So this is what an expense and asset is. Asset is something that you keep with you store it with you, and you use it to generate revenue. Expense also does the same thing. You make calls to clients and customer or you have delivery truck, you spending money on fuel. Delivery truck is an asset, it has a long life. Fuel is an expense, you consumed it immediately to generate revenue. So that's a bit of a thing with the asset and expense. Sometimes it confuses, and I get it. Account receivable is current asset because, for example, in the business, we give like 30-day, 60-day, 90-day, 120-day credit terms. If you work for a business, for any business, you would see that they would receive invoices. They would give invoices and give credit terms. Credit terms is the famous one. So that is known as accounts receivable. That is why, from the point of view of bank from whom you've taken the credit card, you are accounts receivable because you have 30-day, 30-day, mostly you have to pay your credit card bill. If not, at least you pay minimum payment and you carry it forward, but you're still an accounts receivable. So expense, salaries, expense, you consume the activity now, and within 30 days you're going to pay for it. Accounts receivable is something that you can actually trade in the business as well. You can sell your accounts receivable to someone else for a discount. Okay, now that is confusing. But anyhow, library is an expense because you pay for it on a monthly basis. In her case, probably whatever she consumed, she would pay for it. So let's prepare her financial income statement, legal revenue, that is correct. And what else? This account receivable would not come in expenses. I will take salary expense, telephone expense, law library expense. I would take rent expense and I would take supplies expense. So the only two missing over here are supplies and rent. An account receivable would go. Account receivable removed, salary, rent, supplies, telephone, all items labeled expenses are coming here. And that is how your financial statement is prepared, income statement is prepared. Now, statement of changes in equity is a simple item, it's like a reconciliation statement. What's the time? 9:33. In statement of changes in equity, the only thing we have is the opening capital, profits for the year, withdrawals, and closing balance. So opening capital would come just as a number. Profits for the year would be added, so you plus it. Withdrawals is negative. Also, another thing that can come here is investment by owner. So profits for the year 120, withdrawals 80. I'm just taking an example. The owner decided to invest 250 from his own pocket. And all you do is you just sum the whole thing and that's it. So I'm going to take 100 plus 120 plus 250 minus 80. So this is my closing equity. We would say this is my opening capital, this is my closing capital, and this amount 390 would appear in my capital in front of this title, Jack Tasker Capital. I would say it's 390. Now, what is the difference between an opening and closing? This is the last topic we'll do for now because then I have to give the room to someone else. Opening and closing. What does that mean? So business is on an ongoing basis. It's not like December 31st and you shut down your business and then you start your business next day. Of course, you shut down your business every day. Every day there is a 9 to 5 or whatever your working hours are. Even for businesses which are 24-hour businesses, and I've worked in 24-hour businesses, so even they have a closing date. You have to, for the reason of preparing financial statements for reporting, you need to know, you need to have a cutoff date. Like for your credit card bills, you always have a date that this is the date on which you are billed. You're doing expenses every day, but they have the cutoff date. Okay, 26. My credit card cutoff date is up till I think it's uh, 22nd. And my statement is for that 22nd. My statement is generated on the 18th of the next month or 15th of the next month, something like that. Uh, Yeah, something like that. So you have an opening and you have a closing. The closing of one period is the opening of the other period. Financial statements are usually prepared on an annual basis. Different companies worldwide have different uh, financial year. So we call this the financial year. The technical term is financial year. And most companies in Canada have from January 1 till December 31st. The financial year for Canadian budget is also running from January 1st till December 31st. And then they give you 2 to 3 months to do your taxes and everything. And you have a deadline. Hey, April 30th is your deadline for individuals. June 30th is the deadline for corporations. And for even bigger companies like really huge corporations, they have up till September and so on and so forth. So the regular financial year is January 1st till December 31st. So you would say on, so let's take a date, 01-01 slash 2023. This would be my opening, opening, and my closing is on the 31st of December, 31 to 12 uh, slash 2023. The very next day is my, again, my opening statement. It would come on 1 1 uh, 2024. So this is how my financial year would flow. 1st of January is the opening basically. So what you do is you call it a cutoff date. On that date you start preparing your financial statement, and everything that has happened in your income statement, all the revenue, all the sales you made between these two dates, you will call it your revenue. All the expenses incurred between those 2 days would be your expenses. So everything that falls within these two dates, you would prepare your financial statements on that. So opening capital is the one which is on the opening date. So this is, for example, January 2023 first. And this would be your December 2023. But at the same time, when you're going to start preparing the financial statements for the year 2000, this is, let's say, uh, so key statement of changes in equity for 2023. Now, when I'm going to prepare the statement of changes in equity for 2024, my opening, sorry about my spelling mistakes. My opening capital is simply going to be this 390. So it's just on a continuous rolling basis. Then whatever the profits would be for the year, and this statement is prepared at the end of the year. After 31st December, we start preparing the financials, and then we have like 4 or 5 months to prepare the financial statement. That's a long time. So you have opening capital, you have closing, you would add your profits, whatever the withdrawals, but you have to keep the record for the year. So all the recording for the year is done through these three things. Throughout the year, you're working on general ledger, general entry, ledger, trial balances. So when they say, hey, we need a general accountant for this function, so basically those general accountants are accountants, payable accountant, accounts assistant, bookkeeper, whatever you call them. They're working on these three items. At the end of the year, the bookkeeper or the financial accountant, the manager accounts, they're responsible for preparing these four statements. They're prepared over after the end of the year. It does not mean you cannot see them during the year. You can also see them during the year. Hey, up till September, I want to see what my how am I performing up till September. So computerized systems like QuickBooks and Oracle, and they would you would just click a button, and till that day, they would show you the financial statement up till that day. Because these numbers, it's just a number, it's an imaginary or it's a pretend cutoff date. It doesn't mean that you're not working throughout the year, you cannot prepare. So if you decide to close your business, this is what happens when we close business in the mid of the year. So they would prepare financial statements for those for that time period. For example, the business came to an end in September. So we would prepare financial statement as of that day. For example, the business last day of operation was 17th of September. We would prepare financial statement for 2024 on 17th of September. So that is the concept of opening and closing. It's on an ongoing basis. If the business continues, then we follow the year of the business. If not, then whatever the cutoff date is, that is decided by the business. So this is the concept of income statement and financial statements and everything. I'm sorry, my throat is now no longer with me. Okay, so if we've done with the income statement, we're done with the statement of changes in equity, and you can see the capital, starting capital 0, investment by the owner, and profit for the year. Where did this amount come from? This amount comes from the profit, the income statement. So you cannot prepare statement of changes in equity till you prepare the income statement. Why? Because you need this number, the profit, and without profit, you cannot close a statement of changes in equity. So that is why the order that I showed you, you have to work in that order. Oh, come on. This is the order. Income statement comes first, then statement of changes in equity, balance sheet. Because income statement will give you profit, that would go in your statement of changes in equity, the profit. And then the final amount from statement of changes in equity, this amount 390, this is the one that I will take. 580, it comes here, 5880. We add it, we get this amount 16380, and then this amount 16380 would go and form part of your balance sheet on the equity side. And that is how you would balance your balance sheet, debit and credit. And all you have to do in this one is just identify, drop down, identify. That's it. I don't think we can do anything with this. Yeah, we cannot. So that is now your income statement, equity, and balance sheet. I have 15 more minutes. Let's try and push it if we can. So this one is also a bit tricky. I don't know why they have anything like this. I would just simply go for debit and credit. For each of the following activities, identify the effect on each component of the income statement and balance sheet. Enter all amounts as positive values if is both increase and decrease, like both. And okay. So now you have to do what I was showing you in the beginning. We were doing this. First step, they have identified this for you. You don't have to do the first step. How? You can see over here, they've entered this. You have to identify that it's a revenue, and revenue is what is happening. 14,000 of services were provided to clients on credit. So now two things are happening. Services are being provided, which is sales. What is sales? Sales is revenue. So 14,000 is increasing, increase. Now you just have to do, you don't even have to do that. You just have to do directly to third step, increase, decrease, plus, minus. That's what you have to do. Even easier. And so you have to identify, provide it to clients on credit. So there is sales that is taking place so this is revenue and it's on credit, which means you're not going to get cash. Instead, you're going to raise accounts receivable. And what are accounts receivable? They are an asset. So increase by 14,000. So they've entered the amount. You just have to go through it. 5,000 cash was collected for services performed on credit last month. Cash is increasing. And accounts receivable is directly decreasing. So I don't know why they would both. Yeah, so exactly both. Both means plus and minus. That's just weird. So for this 14,000, out of this 14,000, somebody paid you 5,000. So cash is increasing, but your asset of 14,000 account receivable, which had increased before, now that would decrease because 5,000 of those account receivable are now going to pay you. So account receivable will decrease and 5,000 cash would increase. So that is why they're saying both. Plus and minus both is happening. That is such a weird type of questions. I don't know whether you would learn from it or not. I hope you do. So this is what you have to do. Now I'm tempted to do a part three as well. 25,000 cash was borrowed from the bank. What is happening? Your liability is increasing because you're borrowing. So liability increase. Cash is an asset. Cash increase. So asset under asset, I will come see 25,000. Oh, wow, it's increasing. Liability, 25,000 under liability increasing. So this is how you're going to do that one. I'm not going to solve the whole thing, but I will let you see this. If you can, if you want to, you can, since this is getting recorded. So for other students who are not here, you can pause and you can see it. I'm okay with that, but try to do it on your own, then see the solution that will help you. Complete the chart below by selecting yes, no in appropriate column. This is from the type of business organization. Limited liability, this is open book. You can actually see it in your book as well. Sole proprietor partnership corporation, do they have limited liability? Sole proprietor partnership does not have. They end up paying through their assets, personal assets. Corporation does. Unlimited liability, and the exact opposite of that for all of these. Owners are shareholders. No, no, but in corporation, they are owners are partners. That is only in the partnership. Tax as separate legal entity, only corporation is a legal entity. Always create a corporation when you're doing your business, even if you're an Uber driver. That's a good tax advice. The accounting, accounting records of Clear Delivery Services show the following assets and liability as of the end of 2023 and 2022. Prepare balance sheet for the business at the end. So all you have to do, the amounts are there. You just have to identify them properly again. That's it. Prepare balance sheet as at the end of 2023. So this is end of 2022. This is end of 2023. That's it. You just again have to just do the drop down and identify. The following financial statement information is known as about 5 unrelated companies. This is the one of my students was getting stuck. What's the time? 9:50. Okay. I'm going to do this one quickly enough. Uh, okay. Oh, come on. So now it's asking us a couple of questions. What was the equity on December 31st, 2022? First question. equity on 1st December 2000. So all you have to do for this question, just prepare the asset equation. Asset is equal to, oh, okay, whatever. Asset is equal to liabilities, liabilities, and equity. This is how you're going to solve this one. So the first question was, what was the equity on December 31st? The value of asset is 106,000. Liabilities is 46,000. So what is going to be my equity? Since it's an equation and it has to always balance, I'm just simply going to do 106 minus 46,000. 60,000 is my equity, and that is correct. Question number B, part B is, what was the equity on December 31st, 2023? December 31st, 23, for what was the equity? It's for company A. Okay. Mm, so for that, first we need to have the liabilities as well. 112,000. I don't know the liability, but I know the statement of changes in equity, which is 26,000 minus 24,000. And we have withdrawals. Withdrawals is always a negative value because they're taking the money out, right? So I'm going to do a sum over here, and I'm going to copy this formula. Wow. So first of all, I need to know the liability, and liability is going to be 112 minus whatever the equity is, 116,000. And you can see if I were to add, this will come to 112,000. While it's negative, but it's just an equation, just to think about it as an equation. So it always has to balance 112, 112. I'm going to put the sum figure over here. I'm only adding liability and equity because they're two separate. Asset is a single standalone item. So you can see now, I will bold. These are the two lines that we have to balance always. So 112, 112, balance close. But this is not part B. Part B is asking what is the value of equity on December 31st, 2023. So the 60,000, that is what they're doing is, so in this is question A, this is question number B. First of all, we have to figure out the value of the liability. So basically, no, incorrect. What they're doing here is whatever that is equity from 2022, they will bring it down and they will add it up. So no, because as we discussed the concept of timing, anything that is end of 2022 is the opening of 2023. So they're also bringing the equity from last year. Just remember this for this question only. I'm going to bring it down. How do I do with it? And this is the addition. So it's coming 55,400. All I did was add it all up, whatever that is in the question, all of these, and whatever the difference from the last year is B. Quickly, let's do C. Oh shit. C. What was the amount of liabilities owed on December 31st, 2023? Liabilities on December, for the same thing, December 2023 liability. Huh? What was the amount of liabilities owed on December? So we need to figure this value out as well. So this is going to be, since it's an asset equation, asset minus equity 56,600. So those are two answers. B was this and C is 56,600. I just simply did the addition subtraction 112 minus 55,400. Where did we get 55,400? We took all the amounts over here and we added 60,000. That is the amount we discovered from the 2022 statement. And I just added it and I got 55,400 and that's that. Now comes question number 2A. What was the equity on December 2020? 2A, equity on December 31st for company B. For company B, what is the equity? Very simple. Again, 121,000. And we have the liability, 53,000. Equity is going to be 121 minus 53,000, 68,000. That is my answer. That is correct. That is correct. What was the equity on December? For the same thing they're asking in uh, 2B, what is the equity over here? 98,000 is the asset. This is the last that I have to go. 63,000, sorry, 53,000 is my liability. What am I doing? Sorry, 63,000 is my liability. And then we have a brought down figure of 68,000 from 2022. Then we have 35,000 owner investment. Then we have owner withdrawal of 7,600. So I'm just simply going to, that was 35,000 was our answer, sorry. We don't need to do any of these calculations. It's just this difference, that is 35,000. To B, then we have to see what was the profit and loss for 2023